No missiles, no tanks, no troops crossing borders, and yet entire countries lose years of progress in weeks. Currencies collapse, governments fall, pensions vanish, food prices double, not because of war, because the market decided to pull the plug. This is how financial markets punish countries without ever firing a shot. And the uncomfortable truth is this: for most modern nations, the fastest way to lose sovereignty is an invasion. It's losing investor confidence. Right now, this matters more than ever, because we're entering a decade where markets are more powerful, more impatient, and less forgiving than at any point in modern history. Let me show you how it actually works. Not the slogans, not the press conferences, the machinery. Imagine a country. Not a failed state, not a dictatorship, a normal country. It has schools, hospitals, roads, civil servants, a military, social programs, elections. All of that costs money, more money than taxes alone can cover. So the country does what almost every country does. It borrows from banks, from pension funds, from insurance companies, from foreign investors, from the market. At first, it feels harmless, even responsible. Borrow today, grow tomorrow, pay it back later. And for a while it works. The economy grows, GDP rises, politicians celebrate, ratings agencies nod politely. But underneath, something subtle is forming, a dependency. Because once a country starts borrowing, it has to keep borrowing, not just to fund new projects, but to roll over old debt. That's the trap most people never see. Countries don't pay off debt, they refinance it. Every year, old bonds mature, and new bonds must be issued to replace them forever. This means the market isn't just a lender, it's a gatekeeper. As long as investors believe the country is safe, money flows, interest rates stay low, everything feels stable. But belief is fragile. And belief in markets is not about morality, it's about risk. Here's where the punishment begins. It never starts with a headline. It starts with a spreadsheet. An analyst notices something. Debt is rising faster than growth. Foreign reserves are thinning. The currency looks overvalued. Politics seem unstable. Energy imports are getting expensive. Global interest rates are moving up. Nothing dramatic, just enough to raise an eyebrow. So they demand a slightly higher yield, just a fraction of a percent. The government shrugs, no big deal. But higher yields mean higher borrowing costs, which means more tax revenue goes to interest, which means less money for everything else. That makes the numbers worse. Another analyst notices, another fund adjusts its models, another rating outlook quietly shifts from stable to negative. Now borrowing costs rise again. Still no crisis, still no panic, until one day a large fund decides it doesn't like the trajectory. Not because the country is collapsing, because there are safer places to park money. So it sells. That sale weakens the currency. A weaker currency makes imports more expensive. Energy prices rise. Inflation ticks up. To fight inflation, the central bank raises rates. Higher rates slow the economy. Slower growth makes debt harder to service. Now the math looks uglier. More selling follows. This is the moment when journalists start using words like pressure and concern. But the real damage happens quietly. Foreign investors stop rolling over debt. They demand repayment, in dollars, in euros, in hard currency. The country scrambles, foreign reserves drain, the central bank intervenes, it burns through billions trying to defend the currency. Markets watch, and when they see reserves falling, they don't calm down. They panic. This is the absurd part. The very act of defending stability signals weakness. So the punishment accelerates, the currency collapses, imported goods become unaffordable, fuel shortages appear, food prices spike. None of this required sanctions, or bombs, or blockades, just exits. Now the government faces impossible choices: raise interest rates even higher and crush the economy, or print money and fuel inflation, or slash spending and trigger unrest. Every option hurts, and markets know this, so they wait. Sometimes they offer help. IMF programs, emergency credit lines, conditional loans, but help comes with rules: cut subsidies, raise taxes, privatize assets, freeze wages, reduce pensions, austerity, dressed up as discipline. And here's the cruel irony. By the time a country needs help, it has already lost. Because markets don't punish recklessness. They punish weakness. They punish dependency. They punish countries that need constant refinancing. They punish those without leverage. You can run responsible budgets for years, but if global conditions turn, if interest rates rise in the US, if capital finds a safer home, you can still be punished. This is why two countries can face the same shock, and have completely different outcomes. One survives, one collapses, not because of morality, but because of balance sheets. Now let's talk about the uncomfortable math nobody likes to say out loud. Financial markets don't care if a country is democratic, or popular, or morally right. They care about one question: will I get paid back on time in strong currency with minimal drama? If the answer becomes uncertain, money leaves, and money moves faster than any army ever could. In 1997, Asian economies learned this. In 2008, parts of Europe learned this. In 2018, emerging markets learned it again. In 2022, even advanced economies felt the edge of it. This system rewards countries that already have capital, deep markets, reserve currencies, political credibility built over decades, and it punishes those that don't, which creates a quiet hierarchy. At the top, countries that borrow in their own currency and set the rules. Below them, countries that must constantly prove themselves. Below them, countries one bad quarter away from collapse. Publicly, we talk about free markets, confidence, global integration. Privately, the system runs on fear. Fear of being last out. Fear of holding the bond everyone else is dumping. Fear of explaining losses to clients. This fear is why punishment is so sudden, so brutal, so unforgiving. And here's the part that should make you uncomfortable. There is no final authority in this system. No courtroom, no appeals process, no vote. Markets don't deliberate. They react. And once the reaction starts, it feeds on itself. Governments can change. Policies can improve. But confidence, once broken, takes years to rebuild, sometimes decades. Which brings us to the long-term risk. As more countries rely on borrowed money, as global debt climbs, as interest rates normalize, as geopolitics fractures trust, the margin for error shrinks, more nations will discover how thin the line is between stability and punishment, not because they failed, but because the system is designed to be unforgiving. So the next time you hear about a currency crisis, or a sudden loss of market confidence, or emergency talks with lenders, understand what you're really seeing. Not chaos, not mismanagement, not even necessarily corruption. You're watching a silent enforcement mechanism at work, a system where power doesn't wear uniforms, it wears spreadsheets, and the most dangerous weapons are expectations. Which leaves one question hanging. If markets can punish countries without firing a shot, without accountability, without borders, who exactly is this system built to protect? And how long before even the strongest players discover they're not as immune as they thought?